one of the world's leading forex and CFD providers, and welcome to our webinar on Bollinger Bands. Now, Avexo is a regulated provider, and if you can't access their website, it's because they are not regulated in your home country. But if you want, you can go to www.alvexo.com during class and open a demo account by just picking a email, inserting your email address and picking a password, and you can use their charts to follow along and begin putting Bollinger Bands on your trading charts. Now, tonight's class is being recorded, and if you'd like to see a recorded version of this class, it'll be available in about 24 hours by going to investing.com, who sponsored tonight's class, and look under the Education tab and go to Webinars on Demand. Or visit Alvexo for their extensive education platform, offering you a full library of ebooks, a huge range of videos, and also one-on-one training with a financial advisor. Now, because Alvexo is a regulated provider, I need to give you a risk warning, so let me read that and get it out of the way. Trading forex, CFD, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. So let's get started talking about Bollinger Bands. Now, Bollinger Bands were developed by world famous money manager John Bollinger. Makes sense? Bollinger and Bollinger. Okay. Now, they were first developed for the stock market and then have been adjusted with time, because when he developed them, which was about 30 some years ago, they were not, there was no online forex market, no online trading, no CFDs, but over time they have been adjusted and they work well for all types of financial markets. Now, I've given you a handout that gives you some explanation on Bollinger Bands, but we're going to be going over everything in class tonight. Now, what we're going to do first is we're going to look at how to put Bollinger Bands on your chart and what each of the lines come from. Where do the mathematical calculations? You're not going to have to do any calculations. And once you understand it, but you have to understand where these numbers come from, so that it helps you spot when something is out of whack or something isn't working right. Now, Bollinger Bands can be applied in all financial markets, including equities, forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short time periods to hourly, daily, weekly, or monthly. Now, Bollinger Bands answers a very important question. Are prices high or low on a relative basis? By definition, price is high at the upper band of a Bollinger Band channel and price is low at the lower band of a Bollinger Band channel. And this bit of information is incredibly valuable. It is even more powerful if combined with other tools, such as other indicators for confirmation. Now, Bollinger Bands are a type of technical analysis tool. Specifically, they fall into the area called trading bands or envelopes. Trading bands and envelopes serve basically the same purpose. They provide us relative definitions of high and low. Bands are usually thought of as employing a measure of central tendency, such as a base, such as a moving average, whereas envelopes encompass the price structure. So let's go over and take a look just at really where or how we put Bollinger Bands on a chart and the lines involved in a Bollinger Band. And then we're going to go back and understand where these come from. So let me pop up. Here we go. This is a gold chart. And let me hide the Bollinger Band. This is a standard gold chart, 1 hour chart of gold trading this evening. And I'm using, just for ease of viewing for you, and my preference is always a bar chart, but also for viewing on your screen when I've dropped the Bollinger Bands on here, it's easier for you to see it without the reds and greens from candlesticks. So to drop them on the chart, all we do is go to our indicator, and it doesn't matter what charting service you're using, they're all going to have an area where they have indicators, and you're going to scroll down till you find Bollinger Bands, and then you just click on it, and it will automatically drop these bands on your charts. Okay. Bollinger Bands is one of the few technical indicators that actually goes right over top of price action. As most of us know, the things like RSI, MACD, Stochastic, all are placed below, and there's separate little chart areas. Bollinger Bands is placed over price action and forms a channel or an envelope or band around price movement. There are 3 lines that make up the Bollinger Band. These are a moving average line, which I've got here in red, and you can make them any color you want. I picked red and blue for tonight's class because it's just easier for you to see on your screen. We also have, this is called the upper band in blue here, and this is the lower band. So this is all the Bollinger Band consists of, are these 3 bands or 3 lines, and they all have a value assigned to them through a mathematical calculation. And no matter, again, what chart you're using, you can customize these quite easily by changing color. Like I said, I just find where you find the format line. And see, I've set the basis of the moving average line for red. I've set the upper band and the lower band for blue just for you to see it easily. And I've set the background to bluish gray so you can see the background because I just need contrast for tonight's charts. Bollinger Bands uses a standard set of information. We're going to use a 220 standard Bollinger Band. Now, you can adjust these. And we're going to talk about what the standard deviation is and what the moving average. But once you adjust them, they're really no longer Bollinger Bands. They're Barry Bands. They're Bill's Bands. They're Arnold's Bands. They're Zach's Bands. But they're not really Bollinger Bands. They work the same, but you can't then apply the same strategies. So let's go over back to my PowerPoint and figure out what the mathematics are for each of the lines. Because after you understand it and know it, you'll never do a calculation and you'll never look at them again. But you have to understand what the standard or what standard deviation is. And Bollinger Bands uses something called standard deviation. So let me pop up my PowerPoint again. Now, like I said, Bollinger Bands use something called standard deviation. In the real world, no statistician would ever calculate standard deviation by hand. It's a very complex mathematical formula. The calculations involved are somewhat complex and risk of making a mistake is high. Also, by calculating by hand is slow, very slow. And this is why statisticians rely on spreadsheets or computer programs. Now, a standard deviation is, I'm trying to get to okay. A standard deviation is calculated based on the mean, the average. And in this case, we're using the moving average, which is the red line we put on there, which is the standard moving average. And the distance from each data point from the mean is squared, then summed, and then averaged to find the variance. Or to put it another way, variance is derived by taking the mean of the data points, subtracting the mean of the data points individually, squaring each of these results, and then taking another mean of these squares. Standard deviation is simply the square root of the variance. Okay, well, if you understand a little bit of mathematics, you might understand what all that means. To me, it's a lot of words, and it's mathematical processes I haven't done since my college days. But standard deviation is simply the square root of the variance. Now, Bollinger Bands uses a 2-period standard deviation based on a 20-period moving average. So in its simplest form, the mean is simply the average of all data points in a given set. In investing, for example, you might want to know the mean closing price of the last 20 days, 20 time frames, 21 hours, and we would just call this what? A 20-period moving average. And this can be obtained by adding the closing prices for each session and then dividing by 20. Because markets are fickle at best, traders and analysts use moving averages to adjust daily to incorporate the most updated data. This means the calculation is always taking into account the most recent sessions movements or the most recent time frames. And so Bollinger Band starts out with a 20-period moving average. So that is this red line right here. So we're looking at a 1-hour chart. So this red line is a 20-period or 21-hour moving average. So it uses the last 20 closing prices on the chart, on the bar charts, and adds them together and divides it by 20, and then plots one little line on each number, and then draws the red line through it. All of us know what a simple moving average is. Now, from that simple moving average, which is the mean, we then apply a 2-period standard deviation, which is the square root of the variance of that. Now, from that, we place a plus 2-period standard deviation and a minus 2-period standard deviation that forms, and we put these dots on a chart and we connect these dots with lines, and we get the upper band and the lower band. The funny part here is the upper band and the lower band are 2 standard deviations from the mean. So at any given point, they are equidistant above and below, and therefore form the channel. And the channel moves together, the upper and the lower band. You don't see them moving, they move in connection because one's a minus 2-period standard deviation, one's a plus. And it's all based on the mean or the average of the price movement from the 20-period moving average. So this gives us 3 lines. Now, we're really not concerned with Bollinger Bands on what's really going on in between the bands, a little bit, but we're more concerned with the bands itself. When price moves towards the upper band, it is considered to be high or overpriced in its value. And when it falls to the lower band, price is at a low point of its overall value. So in other words, when price comes down and touches the lower band, we would expect it to bounce off of that lower band. Now, it doesn't have to move directly off, or it can ride through a band, which we call riding the bands. But all the price movement of a price and everything you need to know to set stop losses, take profit points, whether the price is high or low, whether you should be trading it up to go to up, or whether you should be shorting it or going long, is all within these bands. And that's why Bollinger Bands is such an important indicator and relied on a great deal. So now that we have the bands on our chart and we kind of understand where they came from, let me just erase these markings. Let's talk about what we want to see. Now, when the bands are narrow, that's telling you the markets are fairly congested. They're not volatile. When the markets get volatile, the width of the bands separate. So you can see, like down here in the current price today, price was fairly volatile and moves jumped straight up. So the bands widen, not because price went up, because prices was volatile. The price can move up without the bands necessarily getting wider. Okay. When they're narrow, price is moving in a congestion. The narrower the bands, the more contrite the market is. The wider the bands, the more volatile. Because this was a volatile move. Even though it was a very strong rally up, it was a very, very hard rally. And so the markets became, the bands widened. So let me take you back to our PowerPoint. Let's start with trying to understand what to do with these bands. Now, okay, the base for the Bollinger Band is the 20-period base, which can be adjusted. If you feel like adjusting it, the longer the base, the slower it changes. But if you adjust it again, then you cannot apply any standard Bollinger Band strategies because you've changed the band. The upper band is a volatility measure known as standard deviation. It's set at a default of 2 standard deviations, and the lower band is minus 2 standard deviations. So once we have the bands on the chart, we then try to translate them into something that is trying to tell us. So there are 3 primary uses that we can use for the Bollinger Bands. Number 1 is pattern recognition. We can recognize double tops, head and shoulders, and double bottoms within the bands. We have reversal signals. These identify early warning signs of reversal. And lastly, Bollinger Bands gives us trend analysis. It detects trend continuations or the end of a trend. So the first is pattern recognition. Now these patterns aren't patterns like you see on a chart pattern. You know, sometimes you're looking for triangles, you're looking for flags, pennants. Okay. These would be within a chart, on a price chart. At any time, we can recognize them based on support and resistance lines. The patterns we look for on Bollinger Bands are also on price movement, but they are contained within the Bollinger Band. Okay. And what we look for primarily are called M's and W's, which are double tops and double bottoms. And they happen fairly slowly, and you can't recognize them till the 4th leg is starting to develop. But they don't tell you anything till the 4th leg. So what we're looking for is the formation between price movement and the band to make a W, which is a bottom. Price comes down, rides the band, stays in, comes down, can't violate the band, bounces off, it moves back towards the top band, bounces off, it comes back towards that bottom band where it is fairly equal to the previous. And then price bounces off and starts moving up. This is the point we would recognize the pattern. And this is called an N, and an upside down N. So it's the 3rd leg. After the 3rd leg of the band is developed, we actually have an N. So in this case, you know, N is normally this way, but because we're dealing with bottoms, it's reversed and we're forming a W. If we're coming off of an uptrend to a downtrend and uptrend, then we have the standard N, and we're looking at an M formation. So you still have the same 3. 1, 2, 3. This is the second top. This is when we can start using this to interpret it. And what this second top is telling you, that it's moved into a downtrend. So when you see this develop, you can start making some trading decisions. A bullish bottom pattern is formed by 2 successive bottoms in price action, which typically resembles a W. Although at first it resembles an upside down N. So that's what we see on this chart, which is a W bottom. And then we see the exact opposite, which is the M formation. So again, there's one for an upset and one for a downset. The key lies in establishing the bullish positions near the lower Bollinger Band with a target set for the upper Bollinger Band. However, if price continues to fall, it may be strong sign to exit and search for a new trade. So in other words, what we do is when it starts to form the 4th leg, would be to enter a long trade with the projection being towards the top of the upper band. The opposite is true when we have the M formation, and we would develop that at the end of the second top at the third leg, and we would take a short position and look for that to come down to the lower band as our target point. Now, a bearish top pattern is formed by two successful tops in price, which are opposite to the W, form the M. So remember, for everything, there's an up rally and a down rally. Before forming the M is an N will emerge in the price action, and this is the point in which traders should want to get involved. So when at the second peak and the N has been formed by the asset price action, it's time to establish a bearish position in the trading asset. Should price continue to rise after the fact and move higher, it's time to get out of that trade and look for a new opportunity. Now, because Bollinger Bands work with the standard deviation, are done right with price action, we need something to confirm. They need to be combined with other indicators. And RSI is one of the best matches for that. And this will confirm that you have reached the top, because if you see the formation of an N and to make the final M or the W, and RSI is not supporting it being in an overbought or oversold situation, then you'd want to step back. Now, another way that we would want to use Bollinger Bands is to combine them with a moving average. During trends, the moving average holds very accurately, and a break of that moving average is usually a meaningful signal that sentiment has shifted. Furthermore, a moving average can be used as a trade exit signal where a trader does not close his existing positions unless price has broken the moving average. So as we can see in here, we have our moving average line in the center of our bands. And when price moves up and crosses the moving average, so it's bounced off the bottom of the band and crossed the moving average, this is the point we want to consider entering a buy position. When it comes up and bounces off the bands, and we don't want to panic or do anything else. We'd want to get out of that trade at this position when it crossed the band, the moving average again. Okay. Or if we were not in the market and we were looking for an entry point, this is the point we would want to enter when it bounced off the bands and then broke the moving average. And then we could ride that trade all the way down. So we can set our stop losses or our entry points by the crossovers of the moving averages within the Bollinger Band. And we would look for the bounce off of the band and then a violation of the moving average. Now, while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside or the downside, it's important to use the bands to also set risk conditions, not just entry points. Additionally, risk and reward should be set based on the width of the bands or volatility, with narrower risk reward ratios during lower volatility and wider risk rewards during higher volatility. So now, in contrast to other indicators, the Bollinger Bands are non-static indicators, and they change their shape based on the most recent price action and accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of the trend. Remember, when you're using oscillators and indicators like RSI, MACD, stochastics, they are staying within a boundary between 0 and 100, and they stay within there, and you're using the 0, 100, and the 30, 70 as static indicators. In this case, in the case of Bollinger, the indicators, which are the upper and the lower band, are constantly moving. So they're non-static. So they help us very accurately view when we think the trend line might end. So there are a few things you need to pay attention to when it comes to using Bollinger Bands to analyze trend strength. During strong trends, price stays close to the outer band. If price pulls away from the outer band as the trend continues, it shows fading momentum. Okay. So what we're looking for is, as the price is moving up, it's staying above the moving average and staying close to that upper band. Now you're going to have the retracements, but then it moves right back up. When it's unable to hold that upper band and it tries to reach that upper band and is unable to score any higher, and then the next candle or the next high isn't able to even come where the previous high, then it's telling us that that trend is overbought and will most likely be ending. So what we're looking for is the price to ride in the direction of the band and stay fairly close to the outer, in an uptrend to the upper band, in a downtrend to the lower band. So basically you've made a smaller channel between the moving average and the band. Sometimes we get this perfect thing called riding the bands, which gives us a very nice trade, which is when price stays right on that band, and when price is moving right on the price band, then you can enter it and exit the minute it is unable to sustain. So again, we have it here. We have it here. So remember, repeated pushes into the outer band, whether it's the upper or the lower, but don't actually reach the band, show a lack of power. A break in the moving average is often a signal that the trend is ending. So what we're looking for in an uptrend is we're looking for price to stay near that upper band. Anytime it surges up to try to push to it or break above it and can't, and does it twice and then falls lower, it's telling you that trend is over. And of course, the minute it breaks that moving average, so we can see a lot of information contained within that Bollinger Band. So here, this is the same chart we've been using all along. And here we have the upper and the lower band. We have the moving average, and we've just looked at it in a closer time frame. And let's walk through these 5 points. So here we have price riding down the bands. Here it broke below the moving average. Now we're going to explain this in more detail in a minute. Here it's unable to break that lower band. It surged towards it, surged down toward it. It still is not able to come near it. Then it wasn't able to come as low. And then it moved above the moving average and moved up, came down, bounced off, tried to attempt to reset. Outer band, fell off, it broke the moving, came back and tried again, making a double top. I was unable to sustain. And so what we had was 1, 2, 3, 4. Then it went into the downtrend, broke the moving average, moved into the downtrend, rode those bands down, and then was unable to continue on those bands and broke above, came above the moving average, came up, broke the bands, was not able to sustain and moved off the bands, fell below that moving average again, and we were able to get. So that's all of it in a nutshell, but let's talk about it one by one by one. So in one, price is in a strong downtrend, and the price stays pretty close to the outer bands all the time, which is a very bearish signal. 2, price fails to reach the outer band and then shoots up very strongly, even showing an engulfing pattern. This is a classic reversal pattern where the bullish trend strength has faded. In 3, we see 3 swing highs with lower highs. Each swing high reached the outer band, whereas the following 2 failed, fading strength. So we have 1, 2, and 3. So let me get marks and let's follow this through again. 1, price broke below the moving average and then moved down and rode the band down. Okay. A very bearish signal. Then bounced off the band, came back up, tried to push back down to the band, was unable to at 2. We got a bullish engulfing pattern here, with the candlesticks, bounced up, came above the moving average, and moved to 3. Here we have the 3 surges up to the upper band. 1, 2, 3, which is telling us that uptrend is over, it's lost its momentum. So we then move over to 4, which is a strong downtrend where price stayed close to the outer band. It tried to pull away, but bears were always in control. 5, price consolidated sideways, not reaching the outer band anymore, and then the rejection pin bar ended the downtrend. So as you can see, Bollinger Bands alone can provide a lot of information about trend strength and the balance between the bulls and the bears. So once Bollinger Bands became very well accepted and people or traders started to look for the width of the bands and tried to make some analysis, John Bollinger created what we call the percent B. And the percent B is an indicator that depicted where price was or is in relationship to the bands. And then he added bandwidth to depict how wide the bands were as a function of the middle band. Because we're constantly looking, remember I told you, we want to see where the band is and where the moving average is and where price stands between the upper and the lower bands. Well, he then put this into a mathematical calculation. So percent B is an indicator for measuring the distance between the Bollinger Bands. The wider the bands get, the more volatile the market is. Appropriately, this indicator is just called the Bollinger Band bandwidth, or just the bandwidth indicator. And it's simply the value of the upper band less the value of the lower band. Understandably, assets with higher prices tend to have higher band readings, but it's still the difference between the two. And we're able to drop that distance on a chart below the price chart. And this tells us the volatility of the markets and helps gives us enter and exit points, because it tells us where price stands in relationship to the width of the bands. Percent B is an indicator derived from Bollinger Bands and quantifies the security's price relative to the upper or the lower band. If we know it's sitting right by the lower band, or we know if it's sitting right by the upper band. Okay. Now the percent B is calculated a little bit more weirdly. Okay. Because what percent B does is it gives you a value. So when the price is at the upper band, we give that price a value of 1. When the price is at the lower band, we give it a value of 0. When percent B is above 1, when the price is above the upper band and below 0, so it doesn't tell you how far above or below. And then when percent B is near the middle band, we give it a value of 1/2 or 0.50. So let's not freak out. You don't have to do anything to calculate all this. You simply go on to your charts. And let's go over and add this percent B onto our chart. Okay, so here we have the Bollinger Band we started with. So we now go back over to indicators and we simply scroll down and go to Bollinger Band's percent B. Click on it. And now what you can see, it's been put on the chart below us. And if you notice on the right-hand side of the chart, we have the 1 and the 0 line. Okay. And the price has been assigned a number based on where price is in relationship to the bands. So when the price is over top or higher than 1, means the price is outside the band. When price is at 1, means it's right on the band. And when price is below 1, it is somewhere within the bands. When price is at the lower band, it would be at 0. So all this is showing us the movement in relationship to price to the upper or the lower band. I'm sorry, give me 1 second to erase some stuff here. So when we see the percent B on the bottom of the chart, it's the calculation of the movement of the Bollinger Bands. Ideally, when buying a security, we want the percent B reading to be above the 1 for multiple days or for multiple periods. And I've given you in the handout a very big, because we can't go through it all in class, but it's all broken down by percentages and when a price reaches what number, what it's telling you, and how successful it's been in its back trading. Now remember, successful day trading is mostly a game of pennies. The best firms and individual traders who day trade look to scalp for small amounts using Bollinger Bands and percent B to show that intraday edges do exist. Okay. And that is in that handout. And I've shown it's broken down. I've given you the charts to break down. It'll show you how to calculate your entry points and exit points. We looked at 7 different exit strategies on that chart. And you can actually see that you can just use these standardized formulas and just trade for success all the time. So you have this chart within the handout I gave you. And you can see that over these number of trades, the average profit and loss for how many days held, the winners, when the percent B was over 1, and what to set your entry limit, how to calculate your percent B. Everything has been set up, tested, and back tested. So by looking at additional exit strategies, the percent B correct goes up by a healthy amount. We now have strategy variation showing percent correct levels up to 77.61, all the way up to 82%. So if you can find trades that always will have an 82% success ratio, all you have to do is use those calculations and don't worry about strategies. So as you can see in summary, knowing how to exit a Bollinger Band trade is as important as knowing when to enter one. By looking at various precise exit points, you're able to see more variations with high edges and historically high probability of trading. Because to be honest with you, no matter what strategy you're using, no matter what indicator, what you're looking for is high probability opportunities that give you an edge up in the market. Too many of us get married to strategies. Too many of us get married up to, oh, I think Bitcoin's going to soar, so I'm going to buy it now because I think it's going to. Well, basically what you're looking for is a high probability trade. I don't really care whether Bitcoin goes up or down. All I want to do is trade it now for a short period of time and make some money. Whether it's going to go up by the end of the day, I don't care. I only care where it's going to do over the next hour to 2 hours. So successful day trading is mostly a game of pennies. But Bollinger Bands, and especially the percent B component of the Bollinger Bands, have had a large quantified edges when you apply them in a systematic manner. There's a preciseness here using Bollinger Bands in this way. Uses preciseness to your advantage. There are literally hundreds of potential variations for you to use, from the depth of the percent B level to the number of days below the level to the size of the limit and to the type of exit that can be applied. Look at the entire scope and then identify the variation or the variations that best fit your trading styles. One of the easiest methods to use in CFD trading is the Bollinger Band squeeze, and it's a straightforward strategy that is relatively simple to implement. First, look for an asset with narrowing Bollinger Bands and low bandwidth levels. Ideally, bandwidth should be near the lower end of its 6-period range. Second, wait for a band break to signal that the start of a new move, and an upside band break is bullish while a downside band break is bearish. So in other words, look for price to break the band. Okay. Then look for it to bounce back in. Note that the narrowing bands do not provide any directional clues. They simply infer that the volatility is contracting, and traders should be prepared for a volatile expansion, which means a directional move. So watch the bands and keep an eye on the bands, and you'll be able to see these. Even though the Bollinger Band squeeze is a straightforward, charters should at least combine this strategy with basic chart analysis to confirm signals. So as you can see, the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buy and sell balances, or potential trend shifts. Together with the moving average and RSI, Bollinger Bands make for a great foundation for any trading strategy. So hopefully you learned a little bit tonight, gave you some food for thought. You're not going to master Bollinger Bands in one session. You can go on the internet and look for the nice thing about Bollinger Bands is because John Bollinger still is alive, still is teaching his bands. You can go and maintains a very active website. You can go to www.bollingerbands.com and get everything directly from the horse's mouth. You could see his strategies and interpretations, how to use band, watch interviews with him, and is constantly being updated and giving you stuff. And this way, you're not going to some guru out there who's preaching you his method of applying Bollinger Band. You're actually getting it from the man who developed it 30 some years ago, 40 years ago, and has been teaching with it for 40 years and has become a market, figurehead. So go to www.bollingerbands.com, or if you go over to Alvexo, who is a sponsor, like www.alvexo.com, and go to their education academy, they have lots of ebooks and videos, or they'll sit with a financial manager to explain to you personally how to use Bollinger Bands. Have a great night, and thank you for joining us. Good night now.